Welcome to Lecture 8 on Risk Management and Insurance. In this lecture, we look at financial intermediaries, including banks, insurance companies, and others. Now, in the credit market, you have two parties, the lenders and the borrowers. And they may deal directly with each other. So a borrower may look for another person who lends money. Or the lender may look for a person who needs money, where the lender can invest the money. Now, if the borrowers and the lenders deal directly with each other, we call it the direct credit market. This may happen in a family. Maybe one family member borrows money from another family member, or it may happen among persons who know each other well. Okay, so one person borrows money, okay, from a friend. Maybe it's also happening through the newspaper. Maybe the lender does a newspaper ad and says, okay, that he or she would like to invest money with another party, with a borrower. That's sometimes questionable. Those newspaper ads, those credit contracts involve sometimes horrendous interest rates. So you have to be careful about that. But the direct credit market exists. So borrowers and lenders naturally can deal with each other directly. Now, the largest amount of borrowing lending takes place through financial intermediaries. So the financial intermediaries play an important role in the credit market, and the borrowing and lending through financial intermediaries is much bigger, okay, than the direct credit market. Now, financial intermediaries play an important role. They provide an important service. They exist because information is asymmetric in the credit market. In particular, the borrower has more information about the riskiness of an investment project than the lender. So the services of the financial intermediaries include to sort out the good and the bad borrowers, the screening of the borrowers. And they provide risk diversification for the lender. So if you are a lender and you provide money to a borrower, then it's just a single borrower. And when the borrower defaults, then your money is gone. When you give your money to a financial intermediary, maybe a bank or an insurance company, then your money will be spread over a lot of borrowers. It goes into a pool of money and it will be spread over a lot of borrowers. And so this gives risk diversification. If one of those borrowers defaults, this has no impact on the lender. So financial intermediaries, they exist because they provide important services. They screen borrowers and lenders, and they provide risk diversification for the lenders. Now, the funds may pass through several intermediaries before the ultimate borrower uses them. So we may have here an entire chain of financial intermediaries, and then in the end, the final borrower gets the money. Now, banks are special financial intermediaries. They also provide transaction services, not just screening of borrowers and risk diversification. You may hold a checking account with a bank, and then you can make payments through your bank account. That's special about the banks. They are financial intermediaries that also provide transaction services. Now, there are many types of intermediaries in South Africa. So here I have it's coming from a study from the International Monetary Fund in 2013. So it was the source is a study of the International Monetary Fund. So the first class of financial intermediaries are the banks. In South Africa, we have had in 2013, there were 29 commercial banks, and their total assets was 3,835 billion rand. Now that's quite a lot. You see the GDP of South Africa is of a similar magnitude, 3,500 billion rands. Now the GDP, that's the so-called gross domestic product. That's the total output of the economy, the total production of the economy in South Africa. So those 29 commercial banks, their asset holdings are roughly equal, a bit more than the total output of the economy in South Africa. So then you have other then you have other types of banks, mutual banks. The Post Bank is just one. There are 3 mutual banks. Then the Land and Agricultural Development Bank, also one, and some cooperatives, which are self-help institutions, maybe of a group of farmers, and so on. They are not very important. The amounts on the balance sheets are small. So really, the commercial banks are here the important type of financial institutions. So the banks is the first class of financial intermediaries. Now, the second class is the non-bank financial institutions. Financial institutions that are not banks. And here we have the insurance companies. We have 186 insurance companies, and again, their asset holdings are large. 2,313 billion rand. So it's a bit less than the banks, but okay, it's still comparable. And then there's the pension funds, a large number of pension funds, again, with huge asset holdings. Then the so-called unit trusts, they include mutual funds, money market funds. Now, those institutions, it's mostly a legal distinction here between institutions. From the point of view of economics, they're just financial institutions. That also applies to the finance companies here and so on. Here again, there are some very small those participation bond schemes. And actually, I don't know whether they still exist. So that's the situation in South Africa. The banks, the commercial banks are really important, 29, and then we have the non-bank financial institutions. Here's the insurance companies, the pension funds, and also the unit trusts. They are quite big. Their asset holdings are quite large. Now let's look here at the market share of the largest financial institutions. So we have the Standard Bank, you may know about it. It's both a bank and an insurance company. You see it has also assets in life insurance. So it also acts as a life insurance company that sells life insurance. But it's also a bank. Now, Barclays, that's mostly a bank. Its insurance business is very small. Then we have the Old Mutual. That's both a bank and an insurance company. Now, First Rand is just a bank. It does not operate as an insurance company. Investec is again both. And then MMI Holding and Sanlam Life, they are just insurance companies. They are pure insurance companies. Those are the most important financial institutions here in South Africa. Now, this combination of banking and insurance that exists in South Africa is quite unique, bank insurance. So it's quite unique that some of those financial institutions are also banks and insurance companies. Now, they tried this in Switzerland. The Swiss banks tried that. They bought some insurance companies, but it did not work well, and then in the end they again sold it. But in South Africa, it seems to be to work quite well. That some institutions are actually both banks, like Old Mutual, and they are also actually an insurance company. But we also have the pure banks, like First Rand, and the pure insurance companies, like Sanlam Life and the MMI Holdings. Now, the South African Insurance Act distinguishes between long-term and short-term insurance, disability insurance, life insurance. That's life, that's long-term. Sinking fund, they are classified as long-term. Now, property insurance, whether your house burns down or if you buy car insurance, liability insurance, that's short-term. That's classified as short-terms. But I must say, the difference between long-term and short-term is not always obvious. Now, major South African insurance companies include here again MMI, Old Mutual, Sanlam. Those are long-term insurers. They are classified as long-term insurance. And then you have the short-term insurance, okay, here. So MMI, Old Mutual, we already had here. MMI, Old Mutual was already here. So their business is considered to be long-term insurance, but then we also have the short-term insurance. Now, I'm quite surprised. Sanlam and Santam are actually different insurance companies, even if their name is quite different. They used to be the same company 20, 30 years ago, but then they split, and one became now we distinguish between Sanlam and Santam. Don't confuse them. Okay, so that's a bit of a shorter lecture today. Next time, we will look at the balance sheets of banks and insurance companies. Okay, so thank you. Goodbye.